First of all, let's get your thoughts on the market's movement. And like I mentioned, October was not a good day. It was not a good time. But we've started November initially poorly, but we've now seen some stability over the next 2 days. Key to that, obviously, has been the bank's results, confirming the relatively low valuations of that sector, in that sector.
Yes, I mean, I agree with you perfectly that October wasn't that very good. But I must say again that a month of October on the capital market is still quite an interesting time. Despite the increase in monetary policy rate, that people would expect that there would be kind of a flight to safety to fixed income instrument, we actually have some good positive return at the end of the month in October. And that actually dovetailed into the early part of November. If you remember very well, the early part of October, we had some quite bloodbath. But the early November, we see some interesting times. And we want to believe that the reason for this is some good result, like you said, that are taking place in the corporate result performance that come to the equity market. The bank's result, I mean, we have seen that there is reduction in the amount of non-performing loans, and then the kind of results that come out from the bank shows that the relative valuation is actually very low, and therefore, I mean, it's quite interesting. So, good investors who understand yield pickup are actually looking to the equity market to pick some yield. That's what we're saying.
You just mentioned the issue of the NPLs, and I think beyond that, what we also saw AMCON do in October was to come out and take out what they considered loans that could pose a negative systemic impact on the broader banking sector.
Yes.
And they've taken all that out, and so more or less clearing the slate, if you like, for the sector. And my question to you is, do you think the market has priced in this well enough?
No.
Because I think it's a very key move.
I agree with you. It's a very, very key move. I mean, right now, there are still some opposing views about what this entails. I think it's a very good move from the MPL, from the AMCON, to say that, you know what, we saw these loans. They are performing, but they have that systemic tendency that should they go bad, there could be some issues. For example, if you look at the rating, Fitch rating for First Bank, which was released some 2 weeks ago, one key thing there was the single obligor limit of a particular loan, which had the tendency of wiping out about 25% of the shareholders' fund of First Bank if it happened. Now, the opposing view is that, look, if these loans are good and the bank is making some good profit from it, why would you take it away from them? If you do that, you have taken away the potential for profitability from that bank. But like we analysts know, that MPL has done a great harm to this banking system and I mean generally to the market. Taking it out is such a great, bold move, and it gives us a very clean slate for people to move on with. Already, because of this argument about whether it is good or bad, we have not actually priced it into it. And that's, again, justified the fact that the banking sector, the stocks bank sector, has really very low value at this moment. Yes.
What about the exchange rates? That's been a topical issue recently.
Yes.
Are you a believer? Do you think that we're going to see stable exchange rate, or do you think there's still a big risk to downside?
I would say that there is a big risk to downside. Yes, I agree that with some, after a period of time, there's tendency that we can have some stability. But right now, we should look at it from this angle. There is global instability, which has affected the global demand for commodities generally, and especially for energy, which is the main source of foreign exchange for Nigeria. Now, if you remember very well, the fiscal authority in Nigeria has actually reacted to this by reducing the benchmark amount, the oil price to $70, and then exchange rate they moved from 153 to 155. These have definitely affected the revenue for like 5%. Although, according to the federal government, it won't affect the budget deficit so likely. But the question is, now our source of foreign exchange revenue has gone down. And since we use the managed float for foreign exchange, we still need to have some good money, I mean, in reserve to back up and fight this thing anytime it comes. So this reduction in this revenue source will have effect on that thing. So as long as there's still instability, especially from the Eurozone, and the America and UK economy is expected to grow at a very little growth rate, where we still have that risk of exchange rate volatility. But over a long time, we can see something.